Welcome to the Cover Your Assets podcast. This is Billy Gwaltney, your host, and I'm really happy to be with you today, as always. In today's episode, I'm going to answer the question of should I choose the benefit increase rider or the future insurability option on my policy? I work with physicians across the country, helping them secure their private specialty on occupation disability coverage. Most of the clients, when I start working with them, are in training still, although I do work with attendings that for any number of reasons didn't get around to this in training. The vast majority of policies include the ability to increase coverage in the future as your income increases. So I'm addressing this podcast to physicians who are asking this question. Which one should I pick? Because the increase rider can take on two forms. Okay, the first one's the benefit increase rider, or BIR. The second one is the future increase option, or FIO. Okay, I'm going to refer to them as BIR and FIO so that I don't get tongue twisted, hopefully. When a policy is approved with the best definitions, the true specialty on occupation definition of disability, the enhanced residual or partial benefit, and the recovery benefit. Those are vital elements of coverage. It's like a three-legged stool. I've covered this in other podcasts and in my book. The absolute non-negotiables to key coverage, or to the really good coverage. If you remove one of those, then your stool falls over. Okay, it's unstable. You need all three. Also, your policy, hopefully, if you are approved medically and it goes through and the policy's issued, it would include the benefit increase rider or the future increase option, the BIR or the FIO, which allows you to increase coverage in the future without having to redo any medical screening, okay, with the same definitions guaranteed to be included on all increase amounts, and with the trainee discount or whatever discount you have on your policy contractually guaranteed to also be included, okay? It's a valuable rider to have to be able to, in essence, flip a switch. Once you become an attending, and as your career grows as an attending, there's a formula that companies use to calculate how much coverage you can buy. And you're eligible to increase your coverage, like flipping a switch, as your income grows. Once your income is at a level where it justifies a higher benefit. Okay. Usually there's a proportional relationship between the benefit and the cost. So if you double your coverage, you're going to, in essence, double your cost. If you're going to quadruple your coverage, you're going to, in essence, quadruple your cost from where you started. Okay. But the medical screening doesn't have to be redone. The trainee discounts included, and the same definitions are included. Most companies, there are four top tier companies, Mass Mutual, Guardian, and Emeritus, have both a BIR rider and an FIO rider. You pick which one you want. Principal only has a BIR rider. They do not have an FIO rider. Okay. The difference, they're both, the BIR and the FIO, are ultimately going to get you to the same place, which is the maximum coverage based on your income. But how they get there is going to be different, and it's going to function differently, and it affects your cost differently. Okay. I'll start with the BIR, the benefit increase rider. This is the rider that has no cost to your policy. Okay. And you are required to increase your coverage or update your income with the insurance company at least every 3 years. Okay. There's a 3-year schedule. And what that means is that every 3 years, you need to update your income with the insurance company. If you do not update your income with the insurance company, they'll take the rider off the policy. So if you ghost them, they're going to say, well, you need to stay at your current benefit amount. As long as you pay that premium, we're not going to allow you to increase coverage without any additional medical screening. You're going to have to start over. Okay. So you have to update your income. If you are eligible for more coverage at the time you update your income, there is a requirement that you accept at least 50% of the additional amount that you qualify for, or they'll also take the rider off the policy. Okay. I'll give you an example. Let's say you had $5,000 a month of coverage. 3 years from now, financially, you qualify for $15,000 a month of coverage. They're going to say you need to at least increase up to $10,000 a month of coverage, or they're going to require you to stay at $5,000 forever. Okay. So there's some guidelines you have to adhere to if you have the BIR on your policy. Now, most clients, practically in the real world, most clients that we work with working with thousands across the country. They're usually ready for an increase at least every 3 years. And if they are eligible for more, they at least want to increase by half of that amount. So it's not much of a requirement. It's not overly taxing to have to deal with these guidelines or these rules. But if you don't adhere to them, then they take the rider off the policy. It's kind of a use it or lose it approach. Okay. What's important to understand is that the BIR rider does not cost anything on your base policy. You're not paying a monthly fee for that. So the insurance company is in essence giving that to you. And in exchange, they decide when and how much. Okay. They call the shots. Okay. That's the BIR or benefit increase rider. The other option or approach is called the future increase option or FIO. And this allows you to increase anytime you want. There's no 3-year rule. And when you do the increase, you can increase by any amount you want. There's no 50% requirement. So you don't have to stick to a certain schedule. You don't have to increase by a minimum amount, where there's usually a minimum amount of like $500 of benefit. Okay. But in that example of you being at $5,000 a month and you're now eligible for $15,000 a month, you can increase by any amount from $6,000 to $15,000. You don't have to do at least $10,000. You can decide how much you want. Okay. In exchange for that flexibility and that freedom, you are paying a fee on your base original policy. It usually equals about 20 to maybe even 30% of the premium cost. Okay. So you're paying a fee for that freedom. There is no free lunch. Okay. That's important to understand. And I know you know that. We all know that. But that's kind of what this gets down to. The benefit increase rider has no fee. Therefore, they decide when and how much. The FIO has a fee, therefore, that you're paying. Therefore, you decide when and how much. Okay. You decide which one you want. And that's really what determines whether or not you should pick the BIR or the FIO. Do you want to pay that fee? Okay. The other thing to keep in mind is that the FIO does have some restrictions on what the multiple is that you can increase to based on the original policy amount that you started. Okay. Whereas the BIR would give you whatever the maximum insurance amount is for your specialty, the insurance company would allow you to have access to that. Okay. So I'll give you an example. 3 of the 4 companies right now have a total insurability amount of $30,000 a month for certain specialties. Okay. If you started with the BIR rider, you would automatically have access to that $30,000 cap if your income supported it. It doesn't mean you can buy 30. It means you would have the ability to buy 30 if your income supported it. Okay, according to the formula. If you start with the FIO rider on your policy, you would not be eligible to get to that full 30. You would be capped at, say, 20,000 of total coverage. So not always, but in certain situations, the FIO will limit the top end amount, the maximum amount that you can ultimately purchase. Okay. However, the key difference to the BIR and FIO is the BIR has no fee. Therefore, they have a 3-year rule and 50% rule. The FIO does have a fee. You pay for it. Therefore, you decide when and how much. Most of our clients typically end up opting for the BIR because of the cost difference on the initial amount when they're in training. Again, most of the clients I start working with, if you're listening to this, you're likely in training. Most are. There are always exceptions, but if you're in training, the difference in $150 a month for a policy with an FIO on it versus $110 a month for a policy with BIR on it, that's noticeable for budgets and on a trainee salary. And so I would say most of our clients ultimately will default to the no cost option and are okay with kind of adhering to these guidelines. The role of your broker is important to make sure that you're reminded. That's where I work with thousands of physicians across the country. We have systems in place. The insurance company notifies you when that 3-year anniversary comes around. They communicate with you about what the 50% amount is. We do the same thing. We notify our clients as well, politely reminding them or bugging them, whatever you want to call it, to make sure that you know that, hey, you need to update your income or they'll take this rider off the policy. and then also making sure you understand what the maximum amount is and what the 50% amount is. So make sure you're working with someone that specializes in this and can keep you updated and is systemized to be able to do that efficiently no matter where you live. Hope you found this helpful. Happy to discuss your situation in more detail. Just meant to give you an overview of the key differences between the BIR and the FIO. Feel free to reach out to me. Text me at 704-270-2376 to arrange a conversation. Again, 704-270-2376. As always, thank you for your time. I'm grateful for that. Take care.